Let me introduce Rakesh Mohan, who is just moved to Yale, and we are very fortunate to have him here with us today. Of course, he has, as you can see from his CV, enormously distinguished career. There are many jobs that he held that are probably not mentioned in that CV, including one that somebody mentioned in I think the country director for the World Bank, Junaid, met you when you were Secretary DEA. So I don't see Secretary DEA in your title, in your bio. So I know there are many other positions he's held which are not there, but he's held Executive Director at the IMF, Deputy Governor, Reserve Bank, headed many commissions. So without much further ado, let me ask Rakesh to give us the closing set of remarks.
Thank you very much. I think what you were trying to say is that I can't hold a job for too long. But thank you very much first to the Institute for inviting me, Vijay, you especially, and others. I was afraid that there would be overlap between what Arvind said this morning and what I would say, but actually there isn't. So relieved by that. He was basically talking about the short term, and I'm mostly talking about the long term. You could have, of course, reversed the two. You could have started with me and ended with Arvind. The advantage of that would have been that you would have had a fuller house in the evening. And so you would have had a longer period of people coming around for the day. What I'm going to do is first a very quick review in some sense of where we've come from, and then get to what we need to do to getting back on the turnpike. And I say getting back to what Arvind characterized as an aberration, that is 2003 to 2008. Let me preface that by saying that even if we grow at something like 8% per year, GDP for the next 20 years, per capita income 20 years from now will be what China is today. Arvind also talked about this. Even better comparison in some sense. Even if we grow at 8% a year starting now for 20 years, per capita income 20 years from now will be the same as what Thailand is today. So we have no time to lose, and we really need to do it. If as Indians, since I'm elderly, if we want something even maybe in my lifetime to be a reasonable level of living in India as a whole, that's what we have to do. The recent growth trajectory, of course, what I call the golden era, Arvind called an aberration. We had a growth pause, actually a pretty short growth pause, 2008-9, from what I always called North Atlantic financial crisis, not the global financial crisis. Because there wasn't a global financial crisis, there was a global economic impact of the North Atlantic financial crisis. We actually then did have continued growth, mainly because of fiscal expansion. 2009 to 12, there was some slowdown again in 2013-14. The GDP growth numbers suggest that we're doing pretty well now. I don't question those numbers because I have had experience with the CSO. I was, in fact, among other things, chairman of the National Accounts Committee in the late 1990s. So I know there's no fiddling there. That I'm sure of. Okay? But I don't understand the numbers. So I'm not saying they're wrong, I'm saying I don't understand what's behind these numbers. Because as Arvind said this morning, that if you have credit growth of zero, or negative credit growth actually, i.e. credit going down to industry, you don't have profit growth, although there was, I think Ratin, you said that last one. You can't go by a quarter. This is the short-term range. So I'm not saying nothing is happening, I'm saying I don't quite understand it. And clearly private investment is not, that's clear. Private investment is not going up. So the question is, and then of course the global scenario, which the current WEO has pointed out, I think, is a continuing slowdown of the global economy, even stronger slowdown of trade, global trade. And that doesn't seem, Europe is clearly not doing very much, US is continuing to grow to a certain extent, Japan is clearly not growing, Brazil is clearly not growing, China is continuing to grow but slower than before. I don't consider that as bad, but that's happening. So there is an issue that can we indeed get back to such an high growth, given that the global scenario is not very encouraging. The past is, the North Atlantic financial crisis, then the European debt and banking crisis, continued protracted recession, as I mentioned, the trade slowdown, and now in the future, the possibility of secular stagnation of people, what people like Larry Summers talk about, and others. I just want to, as I said, quick background from the past. There's actually the sort of been, if you take long views, relatively consistent acceleration since independence, except for the 65 to 81, what I call the Indira Gandhi interregnum. Now, one important point is that it's mostly been financed by rising domestic savings. And that's a big issue for the future, because something that has happened in the last 5 years is indeed domestic savings have come down. The agricultural growth has been variable, basically depending on the weather, but it's around 3% or thereabouts. Now, important point there is that China's agricultural growth was more like 4 or 5%, if I remember correctly. Am I right, Danny? Do you remember these numbers? China agricultural growth? No, Vikram, you're the China expert, no?
I can't remember.
It was certainly more than 3% in terms of high growth periods. Now, one thing with services, there's been consistent acceleration in services, not just recent. There's been consistent acceleration in services. And these are the charts you can show what I've just said, that GDP growth has been sort of on a rising trend since 1950.
If you're taking total savings or financial savings?
No, these are total savings. These are total gross domestic savings and investment. And so you can sort of see that there was a big increase starting at the turn of the 2000s. And then, of course, there's been a drop-off since 2008. And as I said, there's been a consistent record of continuing growth. And of course, at present, I've not updated this to 14, 15, 16 has gone up somewhat. But nonetheless, it is slowed down from before. Now, investment, both the public and private sectors have been drivers. What is important in this chart is the red, the private corporate sector. The high growth period of 2003 to 2008, the big difference really was a big increase in private investment from the private corporate sector. And that is something that is down today, so you can't expect a big growth spurt without private investment going up, along with public investments on a continuing basis. Just quick run through what I said, golden era of growth. All the good things happened in that period. Of course, if all good things happening, you call it an aberration. We can call it golden era. Prudent fiscal policy. The charts that Ratin showed this morning showed the combined fiscal deficit halving that and the central and states combined. There was significant improvement in the tax GDP ratio. Subsidies were controlled in that period. And there was increased public investment as well, which all that led to growth in public sector savings, controlling the revenue deficit. Of course, it didn't go down to zero. Controlling revenue deficit essentially, and also some of the public sector performing better. So there was an increase in public sector savings. There was also what I call complex monetary and financial management. This is where I have a different view from the so-called new monetary policy framework. I think that's not a good thing to do, because India needs complex monetary management along with financial management, not simple-minded inflation targeting. In fact, a recent paper, which actually it was called an IMF paper, but it was actually written by a senior staffer, advisor to then Governor Raghuram Rajan, Peter Montiel, who was a member of the Monetary Policy Committee that recommended the new so-called monetary policy framework, and Rajshri Singh, who was a researcher from IGIDR, RBI's Research Institute, which actually showed relatively conclusively that there's almost no monetary transmission from the policy rates from the Reserve Bank to aggregate demand. It showed mild transmission to bank interest rates. So, what I feel that in the conditions in India, that this so-called modern monetary policy framework of inflation targeting blinds you to other things, and you need more complex monetary financial management. That's what was done during the golden era of growth. Of course, coincidentally, I was managing the monetary policy at that time. So you can take some position out there. But in any case, you had low inflation, low interest rates, nominal interest rates that is. We had very high and very volatile capital flows. So 2007-8, we actually had 10% of GDP net capital flows. They were managed. It was floating, but managed exchange rate. Today, the exchange rate, the real exchange rate, is about 14% higher than 2008, if I'm not mistaken, but I've forgotten since when. But it is the exchange rate, the real exchange rate is clearly appreciated. At that time, banking regulation supervision had tightened, and that got loosened in 2008, 9, 10, and continued. And now, of course, again, there's some tightening. There was very high credit growth, about 25-30% from 2002 to 2010, 2009 or thereabouts. Now, one thing that I was curious about, that with the deterioration of bank balance sheets, I was very concerned that the kind of monetary policy that we followed at that time, the overall financial policy, that the worsening of the bank balance sheet, was it caused by the excessively high credit growth during that time? The answer is no. I looked at the numbers. The deterioration actually took place from about 2010 to 2013, 14 or thereabouts. And that's there in the numbers. And if you look at, and it is coincident with what indeed was it Arvind you talked about, which was the huge infrastructure lending. You talked about it, your brother causing the problem. Shubir talked about it. Sorry, Shubir talked about it. And you talked about your brother causing the problem, Ajay. That the huge impact of PPP, actually, which to my mind is also a result of there not being enough public sector savings to finance the public infrastructure, trying to get the private sector to finance infrastructure, then obviously, I'll talk about this a little more later, that what that meant was always any private sector entity that went into it had to be highly leveraged. And given the risks and standard risks in infrastructure investment, this had the kind of result that we had. So they had high credit growth in 2003, 2008, but that has not resulted in bad loans actually from that time. There was generally high banking for it. One of the very curious things also is that we talk about public sector banks being the problem. But what is very interesting is that between 2002 and 2009, 10 or thereabouts, there was consistently improving quality of public sector bank balance sheets. And they were about very similar by 2008 to private sector banks. Now the question in my mind is that the governance is the same. So you have to really answer the question that why was it that they improved during that time and got much worse somewhat later, that the governance changed? Was it just that because everything was booming, so everything went better? But I think it's too simple-minded to say it was public sector bank problem. The corporate sector, what you mentioned, really boomed during that time. Because there was sustained growth in profitability, they had availability of own savings. And because the fisc was managed, the public sector borrowing went down, and so there was no crowding out. And there was a huge step up in corporate investment that I showed earlier. Similarly, for the households, there was very high growth of financial savings, and also their investment, of course. But the high growth of household financial savings provided the financial savings that both the public sector needed for investment as well as what the private sector needed for investment. It also, of course, robust consumption demand and housing investment. What happened in the slowdown 2012 to 14? Almost the opposite of everything good that was happening in 2008. There was an excessive fiscal and monetary stimulus from 2008-9, absolutely excessive. I can now say that even though I was party to that, 2008-9, but it was over my dead body, and that dead body was moved out and moved itself out in 2009. I can say this openly now, which I couldn't before, that it was over my protests in terms of the excessive monetary stimulus at that time. But however, because of the stimulus, there was revival of growth. There's no question about that. Whereas poor quality fiscal stimulus, there were tax cuts, excessive tax cuts. I do believe there was need for some tax cuts, but it was excessive tax cuts, increase in subsidies, and consequently, of course, reduction in public investment. And after this period, then there was whereas we went down, we sort of expanded the stimulus very quickly in 2008-9, which to some extent was correct, as I said, although excessive. But there was very hesitant withdrawal of both the fiscal and monetary stimulus later. And the revival of capital flows, that after the initial flow out of capital in 2008-9, there was revival of capital flows, and that was not managed. So in fact, if you look at the reserve banks, the foreign exchange reserves, there was no change between mid-2009 to mid-2013. So we actually did not intervene during that period. And again, was a major error. Consequences, high food inflation over inflation, that has been corrected to a certain extent, or mostly corrected. There was a crowding out of the private corporate sector that has been somewhat corrected, with the fisc again being controlled now. The real exchange appreciation took place during that period, that is again happening now. The increase in current account deficit has been corrected, but much more from the import slowdown. Because exports actually been, we talk about the export slowdown because the global trade is slowing down. But actually, our exports growth is negative, okay? But you have to understand that you cannot get 8% GDP growth, along with, say, something like even a high 4% agriculture, but this is just arithmetic, actually. So even if you get, say, services growing at 9% or something, you can't get consistent 8% growth. So all the people who say, no, India forgets manufacturing, consumer services, that's what you're good at, are completely off the mark. There is no way in which you can achieve consistent 8% growth unless manufacturing growth goes up to 8-10%. Now you can then argue, we can't do it. If you can't do it, you can't get 8% annual growth in overall GDP. This is with the assumption of services growing 9-10% on a consistent basis. Now, one of the very interesting things, right for 50 years actually, 60 years in fact, the average incremental capital output ratio, I'm simple-minded, so I think of simple things, is 4.2 actually. India has been relatively efficient all through in its use of resources, somehow. Again, except between 65 to 81. The exports in 2000 to 2012 or so, if I remember correctly, grew at almost 15-20% actually. We were growing, the exports were growing pretty well till about 2012, if I remember right. So when we were doing this projection, we said, we can't expect this, let's let them grow modestly at 12% or so, 10-12% or so. Now that's also not happening right now. And that kind of infrastructure. So the point of this is that even if we grow at the kind of rates that are shown in the chart, 8.5%, 9% going up in the next over 20 years, our GDP will be just about 7 trillion by 2030 or thereabouts, which is lower than what actually China is today. I've talked about manufacturing. These savings and investment requirements, that you really, again, to get something like 8% growth, you need that you need to, we had gone up to about 38% investment, gross domestic capital formation in 2003 to the latter part of that period. Again, you can't achieve this kind of 8% growth unless you go back to that kind of gross domestic investment rate with the corresponding implications of savings. So you can see the kind of investment rate around between 35 to 40%. And wave my hands there, I think 43%, above 40% is too high. I doubt if that can be achieved in India. But you really need to go up to we need to maintain what we had during that period. Now, what I found amazing is that the recent black money scheme, where about 65,000 people declared an average of 1 crore of black money. My recollection is that you don't have 65,000 people from the 2011-12 data that we have from the tax information of people declaring more than 1 crore income a year. So there's a really massive issue of tax compliance on income tax. And we need to increase public infrastructure. Some of it is happening, but again, there's a question mark there. Now, there's some controversy over this. Arvind's economic survey claimed that we are not below the international pattern. I did the same graphs from, I presume, the same data, that is the IMF, the source of all wisdom as far as data is concerned. And you can see the red dot is far below the trend line. So to my mind, there's no question that tax GDP ratio is below the trend line, whether you look at all countries or if you take out countries' revenue GDP ratio of 60%, some of the yeah. So central government revenues have clearly come down since 2008, and you can see the difference that has taken place. For household savings, we clearly need we need a consolidated fiscal policy, but also very clearly monetary policy for maintaining low inflation. I have no difference with that. That you need monetary policy to maintain low inflation, and hence positive real deposit interest rates. That is something that, particularly in India, you need to keep an eye on.
You think 2% is enough?
I don't know. I don't have a good sense of that, but without any, this is my personal gut tells me 3%. Okay, but that's not based on any on any systematic calculation whatsoever. That's my personal gut. So 3% real is what personal gut tells me, but I can't defend that. We need to contain food inflation, and that we need to do much more on the food supply chain on non-cereals also, which we've not done enough at all. One thing we really need to do, and again, Sunal, you talked about this, is really strengthening contractual savings from both points of view. One is from the social point of view, that is for pension schemes and social welfare as people grow older. Also from the financial sector point of view. Also from private investment point of view. Because one of the things that I feel people never talk about is when we talk about either privatization of public sector enterprises, or we talk about PPP, the question is, where are those private funds coming from? In developed countries, most of, say if you have PPP, you have private investment, most of those funds come from institutional funds. Pension funds, insurance funds, mutual funds, and so on. In the United States, endowment funds. They don't come mostly from just corporate savings. So when we say PPP, the question, where is the private equity money? That is why when we did the PPP, what did the private sector do? Quite naturally, that those people who went into infrastructure investment, they leverage like that. Because there isn't that private sector source of equity money that has to come from contractual savings, from pension funds, from insurance funds, and so on. So you really, this whole issue is both household savings, financial savings to go up, for good social welfare, the good functioning of financial markets. I think it's a huge issue which is really not understood enough. You know, when we talk about corporate bond market is not working in India, and we keep talking about that we should fund infrastructure from corporate bonds, not from banks. Who's going to invest in corporate bonds? In this country, who invests in corporate bonds? Not households. The corporate bond market works from institutional investors, not households. We keep talking about households investing in corporate, but who's going to do it? This is a very, very important issue in terms of doing much, much more in contractual savings from all kinds of views, in terms of financial markets, social welfare, and also for infrastructure investment and so on. I've talked about this, I won't say much on this. We're reducing crowding out. We are not managing competitive real exchange rate for manufacturing. Now, we have a structural problem here, which I don't have a very good answer for, which is that we've had actually a merchandise trade deficit of about 8 to 10% of GDP for almost more than 10 years. And the reason it doesn't show up in the current account deficit, obviously, is that we have almost constant flow of remittances from all of you to 3 to 3.5% of GDP, pretty constant. Similarly, what you might call unrequited inflow from IT and other service exports, similar around 3 to 3.5% of GDP. So you have something like 7% of GDP, 7.5% of GDP. Current account flows, which are unrequited in the sense of remittances, or they are from the service sector, which doesn't have much of imports. And therefore, you have a merchandise trade deficit consistent of 10% in the last 10 years or more, while you have still a pretty good current account deficit, and therefore, in that sense, the exchange rate is okay, but it's clearly biased against manufacturing. I don't know the answer how you fix that, because obviously, if the current account is relatively balanced, which I mean about 2.5% of current account deficit on a consistent basis, and you get enough financing from capital flows, your exchange rate therefore is then reasonably balanced. I don't have a good answer to that, but there's no way that you're going to succeed in the kind of manufacturing growth I'm talking about without fixing something on this. So you need a big focus on manufacturing. Ajay is looking at his watch, so I won't go into the into the details of this. But just saying make in India is not going to do it. You really need to think much more both of macro policies, like the competitive real exchange rate, also of micro policies through urban land reforms and labor reforms. The mighty Indian IT sector was given a tax break for how long? 20 years or 30 years? More.
24 years.
24 years. A sector that employs far more people, all kinds of labor saving manufacturing, doesn't get that tax break. That's a tax expenditure that's giving money out. But we did it for the big guys and for high income guys. I've talked about this already, so I won't go into detail of this. The point basically is that most of it we are doing quite right. I'm only a bit nervous, actually more than a bit nervous, of the recent, among the last actions Raghuram Rajan did, which I thought was wrong, to do in his last week of his being governor, of opening the Indian bond market to capital flows. I hope that good sense prevails. We don't do much more of that, but that can cause significant problems. I already talked about this, so again, I won't talk more on that, but I think the key issue is the reforms to do for manufacturing growth. The share of manufacturing GDP, you can see we actually reached the peak in the late 70s. This is too complicated a table for 5:25 in the evening.
Thank you.
But the average of share of output, say, for the Asian countries is about 28%, ours 17%. I will now, you can see most question marks here because everyone refuses to read my transport report. And the mistake I made...
The doorstopper.
Yeah, the mistake I made is in 5 volumes. So it's about 2,000 pages. But there is an executive summary which is only 100 pages. But I still urge you, if you want all the answers, go to that. If you just go to my website, there's rakeshmohan.com, look under the reports, that leads you to the Planning Commission website, which has, they've abolished the Planning Commission, but they haven't abolished the website, fortunately. So you can still see it there. To conclude, to my mind, these things are feasible. We've done fiscal consolidation, we can do low inflation. What we've not done is revival manufacturing, we need a competitive real exchange rate, and we need to step up investment in energy and transport.
Great.